3 years, 3 big changes in tax planning. Hi, this is financial planner Sean Mullaney. Let's discuss. So the tax planning environment has changed. And I think it's really dramatically changed in the last 3 years. So why do I say that? Well, first, in late 2022, so this is December of 2022, Congress passed Secure 2.0. And in there is a very interesting rule when it comes to retirement taxation. Recall, we're subject to RMDs, required minimum distributions, at some point later in life, so that the deferral at some point ends in terms of taxation on these retirement accounts. And commentators have said, oh boy, these RMDs are a real problem. The thing is now, with this Secure 2.0 law change, for those of us born in 1960 and later, RMDs don't start to the year you turn age 75. They canceled 3 RMDs. And let's remember something about the 3 RMDs they canceled for ages 72, 73, and 74. Those, by definition, were the 3 most likely to occur RMDs. That's a big change when we think about, oh, these traditional retirement accounts, they got a problem because they have RMDs. Well, now they have fewer and fewer RMDs. And when we start RMDs at age 75, it doesn't impact that large a slice of our retirement and our life. So that's a big change. Well, you say, okay, what else has happened that has changed the tax planning landscape? And the second thing is the permanent extension of lower tax brackets and the permanent extension and slight increase of the higher standard deduction. So let's think about that, right? When we came into 2025, the law as written said, okay, in 2026, all that good stuff goes away. So that means going forward, RMDs were going to be taxed at, say, a 15% rate instead of 12%. Taxed at 25% instead of 22%, 28% instead of 24%. That all added up, right? That was going to be a big hike back to the old rules for RMDs, and it was going to make these RMDs more harmful. Well, that did not happen, right? One big beautiful bill passed in July. Guess what? The 12% bracket stays, the 22% bracket, 24% bracket stay. And oh, by the way, the standard deduction, that being increased, that stays. And we even kicked that up a notch, $750 singles, $1,500 married filing joint. That's a big change. Those two changes together are quite large when we think about the taxation of RMDs. One thing about that standard deduction that's so helpful is it drags income down. So the tax cut benefit of that higher standard deduction materializes at the highest rate. That makes that so much more valuable to have that higher standard deduction. High standard deduction is really good when we're in retirement, and that's the environment we now face permanently. Right before 2025, commentators said, look, the law is scheduled to change, and we can, some people were like, we can only plan around what the law is in the books, and that's a fair point. I may not fully agree with that, but it's a very valid planning point. And so now with this permanent law change, that's a big, big change. All right, so that's the second change, lower tax brackets, higher standard deduction. Well, there's a third big change in the tax planning world, and that's the new senior deduction. And yes, it is subject to income phase-outs. But the vast, vast, vast majority of married retirees, including affluent married retirees, are going to get most, if not all, of this deduction. And that, for a married couple, is $12,000. File a joint tax return, $12,000. That's fantastic. And again, that reduces taxes at our highest marginal rate. That's huge. And it also opens up planning opportunities like very tax-efficient Roth conversions. It opens up planning opportunities like the hidden Roth IRA. And even for singles, even affluent singles are likely to get some piece of it. Now, very affluent singles will probably lose out on most, if not all of it. But for the vast majority of Americans, the senior deduction is a big enhancement to the tax landscape when we think about taxes and retirement. And so I think, look, I'm a financial planner, advisor, and, many others are. And I think it's time for all of us to reconsider RMDs and taxes and retirement. And, because we've had these three big changes. And just because, 4 years ago, we may have worried about traditional IRAs, traditional 401ks, well, the landscape has changed, and now is the time to reassess and to think about new planning techniques and tactics, such as Roth conversions against the standard deduction and the senior deduction, the hidden Roth IRA, so much more. And I happen to have a resource that could help with that planning. It's called Tax Planning to and Through Early Retirement. It's up on Amazon, other online booksellers. Cody Garrett and I say, look, what does the world look like in 2025 after the new tax law changes? Let's do our tax planning and our approaches based on that world, not the world from 4 years ago, not the world from 10 years ago, right? We've updated our thinking, or at least we hope we've updated our thinking, to be fair. We're always improving, and we hopefully all are always improving and updating our thinking. I think it's time for all of us, whether we're advisors, DIY when it comes to tax planning, it's time for all of us to think about updating our planning. And we hope that Tax Planning to and Through Early Retirement makes a contribution in that regard. Let me know what you think about the new developments in the new tax planning world. What do you think about taxes and retirement? Are you worried about, oh no, there are going to be tax hikes in retirement? Don't worry, the book addresses that. Thanks so much for watching this video. If you enjoyed it, please mash that like button and subscribe to my channel. I will see you next time.